Hello everyone, welcome to this third session for the ACCA Financial Management March 2026 exams revision. I will wait for 30 seconds before we get started. Just want to make sure that we are live and I am audible and visible. I'll just wait for 30 seconds and then we should get started. Sounds good. Looks like we are live. Let's quickly get started. Hello everyone, welcome back to the ACCA Financial Management Revision Live. In the last two sessions, we had discussed the sections of investment appraisal as well as foreign exchange risk management. In today's session, we will be discussing the concepts of working capital management. So without further ado, let's just get quickly started. What is working capital? I don't think this needs any elaboration. All of you are accountancy and finance students, so you know that working capital is nothing but the bloodline of the business. It comprises of current assets and current liabilities, or I would say current assets less current liabilities. Current assets are something that you need in your business to keep your business up and running, whether that is inventory or receivables, and at the same time there is some relief that the business gets by having a line of credit through current liabilities, that is whether it is payables or other current liabilities. Okay, this is nothing but the funds that are needed for the day-to-day operations of the organization. So what is working capital management? Working capital management is nothing but managing all the aspects of current assets and current liabilities. Why do you need to manage the working capital? Why? Because on one hand, you would want to minimize your working capital so that less of your money is blocked in working capital, because of course money has an opportunity cost. But at the same time, you would want to ensure that the working capital is just enough to make sure that there is no insolvency risk and your business keeps going. See, I can talk to you about it in two ways. Hypothetically, if you need money to pay your receivables, but what if you don't have enough money? Another example I can give you is you have customers who are willing to buy your products, but what if let's say you do not have an inventory to be able to sell the products to them? So these are the two examples that I can give you, and which is why working capital management is absolutely important. Like I said, investing in working capital has a cost. What is the cost? Think about it this way. See, if you do not have money and you end up borrowing money to invest in working capital, the cost of funding, let's say you take an overdraft from the bank, then the cost of that overdraft is nothing but the cost of working capital. Let's say you already have money and you're not borrowing money from the bank, but if you would have not invested that money in working capital, you would have invested that money elsewhere in another investment, right? In that case, you would have had some returns that you would have gotten from the investment. So that amount is the opportunity cost of the lost investment opportunities, the cash tied up that cannot be used elsewhere. You can take a look at the example. But the key insight here is that the working capital directly affects your cash flow. Higher working capital means higher cash required, and lower working capital means lower cash required and tied up in the business. What is the need and what are the objectives of working capital management? Something that we just discussed. You need to balance what? You need to balance the cost of funding the working capital management, and you need to balance the loss that you might end up facing if your working capital was not to be sufficient enough. So you need to balance between liquidity and profitability. Profitability means the impact of having less liquid assets, right, on your profitability. And your liquidity means if you have more liquid assets, that will ensure that you can mitigate the insolvency risk. Cash flow versus profit is something that we had discussed in the first lecture of investment appraisals. Cash flows are facts, profits are not facts, they are just opinions. Profits can be manipulated, cash flows can be not. There is always a lag between profit and cash flows. For example, you've sold goods on credit, that will account for in your profits. But having said that, absolutely that will not be considered as a cash flow received until and unless it is actually received. So what is the profitability versus liquidity trade-off? What does liquidity mean? It means you have sufficient cash available to meet your obligations. What are your sources of meeting obligations? It could be your cash balances, it could be your operating inflows, it could be you taking a loan from a bank, which is a short-term loan, a bank overdraft. What is the trade-off though? What is the profitability and liquidity trade-off? If I was to explain you with one simple example, or let's say two simple examples, think of it this way. Again, in fact, the same two examples that I gave you earlier. You have customers who are willing to buy your products, but you do not have enough inventory. Then you will face a loss in terms of profitability. But if you have a very high inventory, then you will have a very high storage cost. You will have a lot of money that will be tied up in inventory. If you have a lot of money that will be tied up in inventory, then there is an opportunity cost of that money. There is a cost of funding of that money. But if you have a lot of inventory, it is quite possible that the inventory also goes obsolete. So too high inventory is also a risk, and too less of an inventory is also a risk. Let's take an example of receivables. Receivables, if you decide not to sell in credit, you decide to sell only for cash, then a lot of customers will not buy from you because you will not be as competitive as your competitors who are willing to sell products on credit. Having said that, if you end up giving a high credit line, if you keep selling goods on credit, then what happens is, what if your customers do not pay you back? Let's assume they pay you back, but they pay you back after a sufficient delay. Then there is a cost of the funds that is tied up in receivables. So this is the trade-off. So effectively, let's say from an inventory perspective, having high inventory means fewer stockouts, and you can have more bulk discounts because you'll purchase a higher inventory, and hence you will have bulk discounts from your suppliers, and you'll have lower ordering costs. Number of times you'll order from your suppliers will be lesser, but at the same time, if you have a lower inventory, then lesser of a cash will be tied up. You'll have lower storage costs and there'll be greater flexibility. Otherwise, the inventory could go obsolete. For receivables, high receivables means, a high credit line means it will attract customers, it will increase your sales. But then again, a lower level of receivables, having more cash sales, means less of cash tied up in receivables, low risk of bad debt, and eventually reduced credit control costs. The other two examples are also quite similar, which is why you just need to have the right amount of receivables, right amount of payables. In fact, even for payables, right? If you have too high payables, then you are happy because you are getting a credit line which is without any interest, right? You are avoiding high borrowing costs, but then what could happen is you could piss off your suppliers. Your relationship with your suppliers will be destroyed if you do not pay them in time. If you have low payables, then probably you could get higher discounts. Probably your relationship with suppliers is really good, and hence you are less vulnerable. You are less vulnerable from a relationship perspective. You will have good supplier relationships. Okay, so those are the examples that we need, and eventually hence we need a balance. We need a balance between profitability and liquidity, and all the 4 chapters within this section talk about the same balance between profitability and liquidity. Working capital policies. At the highest level, there are 2 policies: aggressive versus conservative. What does aggressive mean? Where you have very low working capital, where you want to save your cash, where you want to avoid higher amount of cash being blocked in your working capital. But conservative working capital means you're too conservative, you do not want to take a risk. You'll keep sufficient inventory, you'll keep sufficient, or you'll give credit, higher credit, you'll pay your suppliers in time, you don't want to mess with the relationship. So that is your conservative approach, which is lower risk, but then that will have higher funding costs, and your aggressive will have a lower funding cost, but it will have a higher risk. Why is the aggressive approach a higher risk? Think about it as, if you have lower receivables, then your shorter credit terms, which may make your company less competitive. Lower inventory, what if the company cannot fulfill customer demand, and higher payables, it will risk a damaging supplier relationships. Now what happens eventually is, sometimes there is overcapitalization. What is overcapitalization? You fund the working capital so much, even at a level at which is not needed. There is excessive investment in working capital, too much of inventory, excessive receivables, a lot of cash balances that are kept which are unused, or very low payables, which means working capital is excessive. But in contrast, a lot of people might also do, and this is a high yield exam topic, which is an important exam topic, a lot of people might also have over trading. What does over trading mean? That you have very low level of working capital. And the working capital that is there is funded not by short-term sources, it is funded by longer-term capital. It is funded by longer-term capital, where your company is unable to finance the increased working capital requirements for higher sales. Your sales are increasing very quickly, but you do not have sufficient working capital to be able to. It is exactly the opposite of overcapitalization. Overcapitalization is when your working capital is excess, and overtrading means where your working capital is not enough and your business is growing fast. You need more money, but you do not have enough money. Okay. So what are the signs of overtrading? Your revenue is fast increasing, but then you probably do not have as much of capital. You do not have as much of inventory. Your liquidity ratios are falling. We will study what liquidity ratios are, but I'm sure in other subjects you would have studied what ratios are. You are increasing the reliance on short-term debt. You do not have enough capital. You do not have enough long-term base. You are increasing the reliance on short-term debt. You are lengthening the working capital days. You are delaying your payables. You are delaying your payables, and receivable collection period also ends up getting extended. Most of the assets increases are financed by short-term debt. Even if you are buying a new machinery, you are buying it using short-term sources of finance, whether that is overdraft or that is a short-term business loan, which is not ideal. Remember, in the chapter of sources of finance, you would have studied that you should ideally finance longer-term assets with longer-term loans and short-term assets with short-term loans. But in case of overtrading, you will end up financing assets by short-term credit. Dramatic declining in liquidity ratios. I think 0.2 and 0.7 are quite similar, operating near at overdraft limit. So what is the consequence? The consequence is you do not end up having the money to pay your creditors on time, and you have a higher risk of insolvency. How do you detect this? You will have to see your working capital turnover ratio, which is particularly useful for identifying overtrading. This is something that you can mention in the examination. An exam tip is, when analyzing a company with rapid sales growth, always calculate the working capital turnover ratio and liquidity ratios over a period of time, where you can observe that the ratios are falling over a period of time. You can comment that. You can compare the rate of the sales growth with the rate of working capital growth, and you can mention if the rate of sales growth is faster, then the fact that the overtrading may be occurring. Okay. Now, what are the different working capital ratios? Number one, the liquidity ratio. Or rather, number one, the current ratio. Current ratio, most of you know, current assets divided by current liabilities. What do current assets include? Current assets include your inventory, it includes your receivables, it includes other short-term assets, maybe prepaid bills, etc. And cash, of course. What do current liabilities include? It includes your payables, it includes bills outstanding, any other current liabilities that you may have. An ideal ratio is 2:1. What does it measure? In exam, don't just calculate the ratio. You should also be able to mention what the ratio suggests. What does it mean? It means that how well the current liabilities are covered by current assets. It indicates what? It indicates better short-term liquidity. Conventional benchmark is 2:1, but it varies by industry. What are quick ratios? Quick ratios means how quickly can you convert your current assets? How quickly can you convert your current assets into cash? So now what happens here is, inventory is not easily convertible into cash. It's not like you will go out to the market and sell the inventory. There's enough demand that will be already available. It is not necessary, and hence you will exclude the inventory from the current assets. And the denominator, of course, will be the same. That is your quick ratio, which excludes inventory because it takes time to convert into cash. It measures coverage of current liabilities by liquid assets only. All assets apart from inventory will be liquid assets. I'm purposely going a little fast because this is revision. We need to cover a lot of chapters. But having said that, the viewers, if you have any queries, please feel free to put it in the chat box. An ideal ratio is 1:1, which means the company can end up meeting all the current liabilities immediately if needed. This shows that there is a lower risk of insolvency. Okay, just pausing to see if there are any queries. Okay, query quickly. Interpreting the liquidity ratios. Higher ratios, lower insolvency risk, but excessively high ratios are also bad because they will suggest that a lot of cash is blocked. Lot of cash is blocked, and hence it is inefficient to block so much of cash, and hence you should improve these ratios. For example, some companies use overdrafts as a part of long-term finance, which can make the liquidity ratios appear low. Replacing the overdraft with a term loan would improve the ratios. If you have a lot of short-term finance, then your current liabilities will be higher without having sufficient amount of current assets, and hence the ideal thing is you should have a higher long-term finance so that you can improve the liquidity ratios. Examples are given. Supermarket will always have a lower current and a quick ratio, which is very normal because they generally have cash sales but they have credit purchases. Okay, so eventually it all depends on the industry in which you are operating. What about the cash operating cycle? Cash operating cycle is, which means how much of time does it take for your business or what your cash to have the entire operating cycle, right from your purchase to manufacturing to sale and eventually you getting your money back. So what is the time that the cash takes, time between company's cash outlay when it actually invests the money and finally when you receive the money? The faster the firm moves through this cycle, the lower will be the working capital requirement. Okay, so what are the timelines? Typically, of course, you end up buying the goods first, then you end up selling the goods, then you end up collecting at the most simplest level. For manufacturing firms though, of course, you will first buy the raw materials. Okay, so raw materials holding period, but from that you will have some credit from your suppliers. They will also supply goods to you in credit, which will mean you should reduce those number of days. Then some of the goods you will have as work in progress goods, where half of the manufacturing is done, half of it is pending. Then also you'll have some inventory which is finished good but not yet sold, so there'll be some days added over there. And then finally, once you've sold, the time period between sales till the time that you recover your money is your trade receivables collection period. The total of this, of course, this is a negative number. The credit period that you're allowed by your creditors will be a negative number, but the total of this will be your cash operating cycle. For a retail business, of course, you will skip the steps of work in progress and finished goods. There is no, or I would say finished goods will still be there, raw materials will be skipped. So effectively you just have your inventory holding period less the credit which the trade payables allow to you. Of course, trade receivables remain as it is. Okay, in exam you can be given days like these and you need to show the calculation, which is exactly what is done over here. You can pause the screen and you can take a quick look. Factors which affect the cycle length. The length depends on, of course, liquidity versus profitability decision, the balancing act that we spoke about towards the start. The terms of your trade, of course, not just your terms, but also your suppliers' terms. And of course, needless to say, the efficiency of the management, the efficiency of you yourself as the future CFO of a multi-billion-dollar company, the management efficiency, which is inventory, credit control, and purchasing, and of course, industry norms, which is the example of supermarket that we just saw. Okay, supermarket example is given over here as well. The impact of changes in working capital funding, of course, if you will need a higher cash. If your sales is constant, but your number of days increases, then you need higher cash. But if your days are constant and your sales increases, then also you need higher cash. So either with the increase in sales volume or with the increase of number of days, your cash requirements goes up. The higher the sales is, of course, better, but you should try to keep number of days under your control. You should try to keep it efficient so that lower cash remains blocked. Okay. Next, working capital ratio. We saw the two ratios of current ratio as well as quick ratio. The operating cycle ratios, what are the inventory holding period? We did see the inventory holding period in days over here, right? In days over here. But how do you calculate it? It is quite simple. You will say, what is the total inventory amount in dollar thousands or dollar million? Let's assume this is $10,000, and the total cost of your sales, total cost of your sales. What is cost of sales? Cost of sales means your purchases plus all the cost that you have to incur to make the goods worth selling or to make the goods in a position which are ready to sell, right? Let's assume that number is hypothetically, let's say 100,000. Then what happens? You multiply it by 365. Why? Because 365 days a year, which means your inventory holding period is 36.5, which means on an average you hold the inventory for 36.5 days. It measures the average time period that the inventory is held between the purchase and the sale. Do not forget to write the purpose and the interpretation in the exam. Lower the period, of course, which is better, but very low period also is a problem, because if you don't hold enough inventory, then you will end up risking stockouts. Okay. Next one is detailed inventory ratios. There will be raw material, WIP and finished goods inventory separately. For finished goods, the formula remains absolutely the same, which is what we just discussed, denominator being cost of sales. But for raw material, the denominator cannot be cost of sales. Why? Because the raw material, if you're holding raw materials, then you cannot compare it with the cost of sales, right? You have to compare it with the cost of those raw materials. So the material usage cost and versus what is the raw material that you're holding. Sir, okay, what do we do if there is a WIP investment? What do you do is then what is the production cost at that level? So the WIP inventory held divided by the production cost. This production cost of course will end up including the purchase price or the material usage. And then finally, overall inventory turnover will be cost of sales divided by average inventory. In other words, if you see, it is the inverse of inventory holding period. Inventory holding period was what? It was inventory divided by cost of sales. So the turnover will be cost of sales divided by inventory. Okay. And higher turnover, which means lower number of days. Lower number of days means efficient management. Trade receivables also gets calculated in a very similar manner. Your numerator will be trade receivables. So remember, in all of these formulae, right, when you calculate the number of days, your numerator has to be the current asset for which you are calculating the number of days. Let's say if it is inventory, you calculate, you put that in numerator. If it's trade receivables, you put that in numerator. And what goes in denominator? Think about it, trade receivables. So when you have to receive, who do you receive it from? What is the total amount that you receive it from? You receive the receivables from the credit sales that you would have made. So denominator will end up being credit sales, which means the average credit period extended to customers. A very important exam point, a common mistake that people make is that they consider total sales in the denominator, but your trade receivables represent only the credit sales that you would have made, not the cash sales, and hence the denominator should have only and only credit sales. In exam, if credit and cash bifurcation is not given, then you have to put an assumption. That all sales are on credit. But having said that, if you do not have that mentioned, then in that case you will have to mention only the credit sales in the denominator. Shorter periods, of course, are generally preferable. And you should compare this with the stated credit items. For example, if your collection period is 50 days, but your stated is 30 days, then there's a further delay of 20 days beyond your policy, which means your credit control is weak. You are not able to collect the receivables within the time period that you have given to your customers. Okay. What about trade payables? Absolutely the same as trade receivables, except that over here it talks about the credit purchases instead of credit sales. And then what will it interpret? It interprets how well do you pay your suppliers in time. If you pay them with a sufficient delay, then of course you will end up staining the relationships. You are risking damaging the relationships. But of course longer periods are good because you get free cash financing. Suppliers will not charge interest from you. Okay. Exam tip again, use credit purchases when provided. Look for all purchases are on credit guidance. If at all, the bifurcation between cash and credit is not given. So what is the net working capital ratio, or I would say working capital turnover? Whenever it is turnover, it becomes the reverse of what I just said. The asset that you are measuring comes in denominator and the numerator will be the overall number. Overall number over here for overall working capital, you always compare the working capital with the revenue. So revenue divided by net working capital will talk about your working capital turnover. Of course, you know what net working capital is, which is your current assets minus current liabilities. What does it measure? It measures how efficiently your management utilizes the working capital investment to generate the sales. Which is higher the ratio indicates more sales are generating using less of a working capital. So per unit of working capital, how much sales you are able to make. Rapidly increasing ratio may indicate that the company is attempting to support increasing sales with lower of a working capital, which may end up suggesting which is a sign of over trading that we just discussed. Okay. Using over trading detection, either of these three, if it is a stable or slowing increasing ratio, then it's still okay. Rapidly increasing ratio is risky. It suggests potentially over trading. Cross-reference this with liquidity ratio and see if your liquidity ratio is fine. If it is falling, if liquidity ratio is falling and working capital turnover is rapidly rising, then this is a sign of over trading. Very important from an exam perspective. Do not forget. Okay. In exam, you can expect questions like these, something that I'm just projecting. We've discussed all the formula. You just have to put the numbers in the formula. For example, for current ratio, what is your current assets total? So 520 plus 380 plus cash. Trade receivables will be minus and bank overdraft will be minus because these are if you calculate the working capital. Otherwise, these three are a total of current assets, these two are a total of current liabilities, exactly what is done over here. If it was quick ratio means current assets minus inventory. So what are the number here is 925 minus the inventory of 520 will be your quick ratio in denominator, numerator being absolutely the same. What is inventory holding period? Inventory holding period will be your total inventory, which is 520 divided by your cost of divided by your cost of sales. But over here in the question, are you given cost of sales? Yes, you are absolutely given cost of sales. So you will be able to calculate, which is 520 divided by 3200. Trade receivables divided by credit sales. Remember, 4800 is the credit sales, not the total sales. Are you given in the question? Yes, all the revenue is on credit, so entirely it is credit sales, and here you have been given credit purchases. So you'll be taking credit purchases in the denominator. So what is your cash operating cycle? Add inventory holding period, add receivables, and reduce the payables. That is your cash operating cycle. So what is your working capital turnover? What was the revenue? Your total revenue divided by your total working capital. What was the revenue? 4800. What is your working capital? You add these three and you subtract these two. Okay, that will lead to your working capital. So net working capital is current assets, which is 925, minus current liabilities of 335, which is 590. So 4800 of revenue divided by 590, which is 8.14 times of working capital turnover. Okay, and you have to mention this as you can see, right, you just don't have to do maths, you have to mention interpretation absolutely everywhere. Delta must finance the working capital for approximately 48 days between paying suppliers and receiving cash. There are marks for these interpretations, and you need to always have an overall assessment as well, which is it has a strong liquidity, it seems to have a effective credit control, good supplier usage, whatever, and of course you should mention that a further analysis needs to be done versus its prior periods and the industry benchmarks. Okay, calculating working capital investment levels. This is if for example in the examination you are giving the number of days of your trade receivables. So basically, if you are given trade receivables collection period and you need to find out the trade receivables, you just use the formula. What do you do? What was your formula? Collection period is equal to trade receivables divided by credit sales, okay, into 365. Now what do you do if you want to find trade receivables? Then it is nothing but credit sales into collection period divided by 365. So this is just the inverse of that formula for all the three formulas if you do, so that if you are able to, if you have to rearrange to find out the trade receivables, inventory and trade payables, how do you do that? There is an example which is given. You can just pause and take a very quick look, especially at example 8.2. In the interest of time, I'm not solving this, but we've discussed all the formulae, we've discussed all the logics. You can just pause, you can take a look at the formulae, and you can take a look at how it is solved. Okay, moving on to the next topic, which is factors affecting working capital requirement. What do you think would have affected working capital requirement? Of course, the business that the company is operating in. We just discussed the example of supermarket. Different businesses will have different working capital requirements. What is your supply chain? Is it a local supplier from whom you can easily buy, or is it an international supplier from whom you will have to take a lot of time to buy? In that case, I'm not sure what is SSLC. If you can put that on the chat box. But yeah, so if it is if your supply chain is an international supply chain, you will take more time, so you would want to keep more buffer and hence higher working capital. Okay, business activity, which is if it is a growing company with rapidly increasing growth, then in that case you would have to keep a higher working capital. What is your credit policy of yours plus also your suppliers? So supplier credit policy, and finally, what is the operating cycle length? That will decide the working capital requirement. So this was the overview of working capital management, the different ratios that you look at. This is the chapter summary, plus of course the common exam mistakes that generally people make. So you should again pause the screen and take a look at all of these points. I am quickly moving to the next chapter, which is inventory control, where we deep dive on how to manage inventory better. Okay, so inventory represents what? It represents sufficient investment in most businesses, inventory, a lot of companies have a very high level of inventory, particularly those that are there in manufacturing, because manufacturing process takes a lot of time. They hold inventory about 50 to 100% of their annual revenue. You should take a look at balance sheets, especially pharma companies. They have a lot of inventory, and effective inventory control, hence inventory management, hence becomes super important and crucial for maintaining an optimal working capital level, while ensuring that the business has to run smoothly. Because if you have too high a level of inventory, more of your capital gets blocked, and if you have a very low level of inventory, then there's a risk of stockouts. Then your relationships with the customers may get strained, and your competitors will take an advantage of that. So what is the core challenge? The core challenge is exactly what we've been discussing, something that I just said. While you would want to minimize your inventory level from the perspective of liquidity, so that lesser of an amount is blocked, but then profitability will say, don't risk stock out, keep adequate level. Here you try to say, I want to reduce capital employed. Here I will say, I want to prevent the business disruption. Here I will say, I want to reduce the holding cost. Here I will say, I want to avoid situations where I stock out. So eventually I will have to balance what? I will have to balance cost of holding too much inventory and the cost of holding too little inventory. Both of these have a cost. So what are the costs that are associated with holding high level of inventory? Just ask this question to yourself. If you hold high level of inventory, then a lot of capital gets blocked, which means there's an opportunity cost of these funds. Number two, if you hold a very high level of inventory, then there's a high level of storage cost. You need to get insurance done, so on and so forth. And then finally, there's a high risk that some of the inventory gets obsolete. So these are the three risks. So there's a purchase and opportunity cost, which is capital becomes tied up and you get no return. Right? If you have limited cash resources, then higher inventory will be a problem. Second, you'll have to, if you have higher inventory, you'll have to store high, you'll have to give higher rental expenses, higher climate control, higher security, higher insurance, etc. Sophisticated inventory tracking. At the same time, there is a risk, physical deterioration, obsolescence, damage, also theft or loss, which you cannot disregard. But what if you have too low inventory? If you have too low inventory, then there's a problem. You will risk stockouts. You will risk, you lose potential sales. You will risk damaging relationships with your customers. So customer dissatisfaction because of stockouts, lower sales, of course. And if you have lower inventory, which means the number of times that you'll have to order from your suppliers will be a lot. And every time you order, every time there'll be a logistics cost. Every time there will be a cost of ordering. So higher ordering costs, higher setup costs. Because each replenishment cycle will incur costs. For example, purchase requisition, order placement, delivery receipt, invoice processing, so on and so forth. So there are a lot of processes that go behind ordering raw materials, and hence this is a problem. So you would want to not keep ordering, every day or every week. You might want to order only at a set interval. Last but not the least, there will be lost bulk purchase discounts. Your suppliers will say, okay, if you buy 6 months of inventory from me at once, I will give you a 6% discount. But if you keep buying every week, then you might end up losing those purchase discounts. So on the key terminologies in inventory management, first of all, it is reorder level. What is reorder level? The level at which you would want to place a new order with your supplier. Number two, that is reorder quantity, which is how much should you reorder at each time that you end up ordering. Lead time, what is the lead time within which once you've ordered and once you've received the goods, what is the time period between placing an order and receiving the goods. And finally, buffer inventory or safety stock, which is the minimum inventory level that is required to be kept for protection against some uncertainties. These days a war is going on between some of the countries in the Middle East and the West, so there may be supply chain that is disrupted, so you might want to keep some extra stock just as a safety net. And hence there is this model called, not because of safety net, but there's a model called economic order quantity, which just tells you exactly what is the balance between profitability and liquidity, what is the right amount or right number of units of inventory that you should order every time. See, effectively, if we order, right, there is a ordering cost, and once we've ordered, we hold the inventory, right? There's some storage cost, there is a cost of funds that is blocked, so on and so forth. So there's a holding cost. We kept saying that we need a balancing act. So the level of inventory at which the ordering cost and the holding cost are equal, that level is the economic order quantity. That is the level at which, that is the level of each order which will optimize the which will optimize the which will optimize the inventory levels. Okay, so mathematical approach to determine the optimal order quantity that minimizes the total inventory costs. Okay, now holding costs. What are holding costs? Holding costs are CH, this is per unit, okay, cost of holding, and this is CO, cost of ordering. Okay, so the holding cost will keep increasing. If you have a higher inventory, then the higher holding cost, but then if you have a higher inventory, then the cost of order will be low because the number of times that you order will be lower, right? So holding costs increase linearly with the order quantity. If Q represents the order quantity and CH represents the annual cost of holding, then annual cost of holding is what? Cost of holding per unit into quantity, the total quantity that you will end up ordering through a year, or I would say total quantity that you end up ordering at once. In one order, how much do you order? That is Q, but you divide it Q by 2. Why are you dividing Q by 2? Because when you order, you are not spending the holding cost for the entire period of time, you are spending only it for the half of the time period. Why? Because let's say on day one you've ordered, on day one you are spending, day one you have a holding cost on the entire 100 units, but on day last you are spending the holding cost only on 1 unit, so you have to end up taking the average such that your holding cost is only for the average period, not the full period. So average inventory level is because the inventory fluctuates between the full order quantity and 0 as a sorted pattern as the goods are used. Okay, if buffer inventory is maintained, however, then in that case cost of holding becomes Q by 2, which is of course average inventory level, but you keep a buffer, so buffer will be in addition to the average inventory and hence plus the buffer into the per unit cost of holding, which is CH. What are ordering costs? These decrease as the order quantity increases, because then you'll have to place lower orders if you have a higher order quantity. If D represents the annual demand, then what is the number of orders? Number of orders will be D by Q, Q being the number of units that you order at once, D means the annual demand, so number of orders will be D by Q. So number of orders into per order, what is the cost, which is CO, per order cost. So larger order means fewer orders per year, reducing the total ordering cost. So the EOQ formula is what? The optimal quantity where holding costs equal ordering costs. So what are ordering costs? Ordering cost means CO. What is CO? CO is the cost of ordering into the total demand. So per unit into the total number of units, that is your total ordering cost, divided by the cost of holding. Why multiplied by 2? Multiplied by 2, why? I'll come to that, but you will divide it by cost of holding per unit. So this will give you the ideal number of quantity as you take a square root of this. Okay. So the EOQ model has certain assumptions, which is the demand is consistent or rather constant and known beforehand with certainty. Lead time is constant and known. No buffer inventory is required. Orders are received in a single delivery, and purchasing price per unit remains constant. See, the purchasing price, some of you might be thinking, why do we not have purchasing price in the EOQ formula? We just have cost of ordering on the cost of holding. It is not there because it is assumed to be constant regardless of the order size. It only becomes relevant while evaluating the quantity discounts, which is what we will understand now. You can see one basic example, which is each order costs 40 and annual holding cost is 3.2. So 40 into what is the total demand? 15K. 40 into 15K. 2 into 40 into 15K divided by 3.2, and then you end up finding the square root of this, which is exactly what is done over here. So the company should order 612 units each time to minimize the excuse me, minimize the total inventory costs. For the viewers, if you have absolutely any queries, please put it in the chat box. I'm looking at the chat box parallelly. I don't take board exam revision classes. I teach ACCA and CAs, so sorry for disappointing you. But if there are any queries regarding whatever I've explained thus far, please do let me know in the chat box. So over here, you've been given the purchasing price, you've been given company's cost of capital, you've been given storage cost, you've been given order placement cost. So if order placement costs if order placement costs are given, right, then what does it mean? It means cost of ordering is given at $180, at $180. Okay, you need to find cost of holding. What is cost of holding? Cost of holding is 1.5 at 1.5 per unit. But is cost of holding only the storage cost? No, cost of holding also includes the cost of funding. Cost of funding you will calculate how? The purchasing price is 8, the purchasing price is 8 and the cost of capital is 12%. So 8 times 0.12, which is 0.96, plus you will have to calculate the storage cost. Your total holding cost is 2.46. Okay, so your 2 into cost of ordering into the annual demand divided by your cost of holding. So that will give your economic order quantity. The holding cost includes the opportunity cost of capital in the inventory calculated as a purchasing price multiplied by the cost of capital. Okay, you can also be asked to compare the total cost of these three and verify using the EOQ. You can do all of that quite easy. Okay, what if you have in the examination you have EOQ where you have to calculate using the quantity discount? What do you do? So effectively what happens here is let's say in the equation, right, in the EOQ formula, you don't end up considering discounts at all. For example, hypothetically, if the suppliers say that if you were to buy 500 units, I will give you 1% discount. If you buy 600 units, I will give you 3% discount. If you buy 1000 units at once, I will give you 5% discount. What do you do in that case? Because EOQ does not consider the discount. What if your EOQ was 550 ignoring the discount? And then you might say, oh, I might as well increase the number to 600 so that I get an additional 2% discount. So how do you incorporate the question of quantity discount within EOQ? Suppliers often offer price discounts for larger order quantities. When the EOQ is below the threshold for a discount, we must evaluate whether increasing the order size is economically justified. So what is the decision framework? The decision framework is calculate the EOQ ignoring any discounts. If the EOQ is below the threshold, then calculate the total annual inventory cost at EOQ. Okay, how do you calculate it? What will you say? You will calculate the total cost. How do you calculate the total cost? Purchasing price into the number of units plus you will have total ordering cost. How do you calculate total ordering cost? Cost of one order into the number of orders, which is D by Q. Total holding cost of holding for 1 unit into the average inventory. So that way you calculate the total cost. Okay, P will be the purchasing price net of the discount. Okay, then you have to recalculate the total annual cost using the order quantity required at each discount level, incorporating the discounted price. So if you have 3 discounted levels in our example, I just erased it, but in our example 1%, 3%, 5%, you will calculate it for all 3 levels, 500, 600 and 1000, and then you will compare that with the EOQ and you will see whichever has the lowest cost. So you'll compare all scenarios and then select the one with the lowest cost. Repeat for all the available discount levels. Okay, there's an example that is given. So first of all, EOQ was calculated, then 4,000 units the total cost was calculated, and then at 6,000 units the total cost was calculated. For 4,000, for 6,000, and you compare it with the cost at EOQ level. At cost at EOQ level was 205,000, cost at 4,000 was 202,500, and cost at 6,000 was 202,167, which is lower as compared to the 4,000 as well as compared to the EOQ, and hence the optimal order quantity is 6,000, which, and mind well, this is not EOQ, this is a different quantity as EOQ. Why? Because at this quantity the discount was so much higher that it was negating the impact of cost of holding to some extent. So it ends up providing an annual savings of 3,310 compared to the EOQ. Okay, and if discounts are not worthwhile, you calculate EOQ. Okay, you calculate total cost at next level, and then you see that you are ending up saving. You are ending up saving if you end up taking the discounts, as the savings exceed the additional holding and ordering costs, resulting in a net benefit of 1403. How do you calculate reorder levels? You will say reorder level means the demand during the lead time. What is the lead time? Effectively, if I order today, then if I end up getting my order in 10 days, because of course once you order, the supplier will pack supplier will end up sending the goods through logistics. That will all take time. Let's say it takes 10 days. What is your demand going to be for those 10 days? That is the stock that you need to keep, and hence the moment your stock levels, your inventory levels reach that level, you will have to call your supplier and say, now I have reached the red line, the danger zone, and I have to order at this point. That point is called as the reorder. That point is called as the reorder level. Okay. So reorder level is assuming the wholesaler adopts an order quantity of 6,000 units and the lead time is 3 weeks. Calculate how frequently the orders will be placed. Basically 40,000 divided by 6,000, 6.67 orders, which means 55 days per order, 365 divided by 6.67, and hence your order level will be how much? What was your weekly demand? Your lead time is 3 weeks. So 3 weeks into what is your weekly demand? Your annual order quantity was what? Annual order quantity is 40,000. 40,000 divided by 52 weeks, 769 per week. So 2308 units you need for those three weeks when you order, and hence as soon as the inventory level reaches 2308, you will have to, the company should end up placing a new order when the inventory reaches 2308 units. Okay. Variable demand or lead time. In practice, demand and lead time often vary. In such cases, a buffer inventory, remember we had taken a look at buffer inventory while calculating the cost of holding. Generally, you will keep some safety stock to prevent stockouts. The optimal buffer level depends on what is the variability that you've observed between demand and lead time, what is the cost of holding buffer inventory, cost of stockouts, and finally service level objectives. Okay. Now, certain inventory management systems. We've discussed what is the reorder level. We've discussed what is the economic order quantity, when there are discounts, when there are no discounts. So what is the right way to manage the inventory? Number one is you periodically review the inventory, right? You periodically review at fixed intervals, and at each review, you determine, at each review, inventory is replenished at a predetermined maximized level. The maximized level accounts for expected demand until the next review, plus the demand during the lead time. That's the demand during the lead time. Okay. Let's take a look at an example. Weekly demand averaged 120 units. Reviews every 5 weeks. Lead time is 2 weeks. Okay. So essentially, in a way, there is 7 weeks. Okay. Essentially, there is 7 weeks of demand. 7 weeks into 120. 7 weeks into 120 will 720 into 7 weeks into 120 plus 50. Okay. So 7 into 120 will be 840 plus 50 means 890 units. And already you have 400 units. So 890 minus 400, you need to order 490 units. The second is if you have slow moving inventory. What is slow moving inventory? Let's say screws, right? Do you need screws very frequently? Absolutely not. You need only sparingly. So approximately 20% of the items account for 80% of the use value, and vice versa. 80% of the items account for only 20% of the value. So certain items have high individual value but infrequent demand, and vice versa, right? So what do? You conduct aged inventory analysis, you eliminate obsolete items promptly, and you order slow moving items only when they are needed, unless the minimum order quantities that apply. Okay. If they are low in value, you don't mind keeping them in the stock, but if they are high in value, then you do not order and keep it in the stock because there will be high holding cost. Regular reporting on slow moving items helps management identify changing demand patterns and potential obsolescence early. Next is just-in-time system, absolutely important from an exam perspective as well as for you as the future CFO. JIT represents a fundamental shift in the inventory management philosophy. Why? Because it aims to eliminate all the inventory rather than optimize it. You will say, how do we eliminate? It says JIT systems are based on eliminating the waste, which means any activity that does not add value to the entire process should be eliminated, and hence there should be the balancing act between holding costs and stock out costs is resolved altogether. How? Because you are reducing the inventory to near zero. You don't need the inventory at all. How do you do it? You say that I will order only when there is demand. I will order, and as soon as I get the goods, I will end up supplying the goods, instead of saying I will order first, I will keep, and then if there is a demand, I will sell the goods. Instead of that, you say I will order only so much and only when I have a demand. There are various wastes in manufacturing, which is you will keep inventory, raw material, work in progress. Excessive materials will have handling, you will have quality problems, long supplier lead items, long customer delivery times, etc. So how do you eliminate all of this? You will say, I eliminate all the inventory, I will reduce batch size ideally to single units, create smooth continuous production flow, eliminating raw materials, supplier directly deliver to production areas when the production is happening. You do not keep any inventory. Eliminating quality problems. How do you do it? You design quality, you have high quality processes, you have high quality materials as well as high quality suppliers. You prevent defects rather than trying to solve them, rather than trying to inspect. How do you eliminate finished goods inventory? You reduce production lead times. You say, as soon as there is an order, I will tell you to produce, and please produce as fast as you can. So you manufacture to produce rather than to forecast. You don't forecast your demand. If there is an order, only then you end up manufacturing. And finally, how do you reduce material handling? You say, I will redesign the factory layout for direct flow between workstations. I will minimize the distances for transportation. How do you manage supplier relationships in JIT? You will select the suppliers who have an ability to make fast but smaller deliveries, who are proximate to your facility. Only then they'll be able to make you a fast delivery, and who are able to commit to you a longer term partnership with a willingness to integrate systems and processes. What are the benefits for them? They get longer term relationships also. They have greater flexibility for greater certainty for production planning, and of course they have potential for increased business volumes. What are the requirements? High quality, absolute delivery reliability. If there is less of a delivery reliability, then there is a big problem. Why? Because then what happens is, you have an order, you want to produce, but then what if your supplier has suddenly said, oh, I cannot supply you today? Then it becomes a problem. Impact on logistics: smaller, more frequent deliveries, short notice, stricter delivery schedules. Carriers become partners. You need to partner with the logistics folks as well, and you need to make sure that they deliver to you in time. And then finally, higher transportation frequency but lower inventory costs. Okay, JIT successful outcomes means smooth and continuous workflow, dramatic reduction in capital. So you'll have lesser capital in inventory because you have near zero inventory, you have reduced space requirements, and finally your inventory counting also becomes easier. I know this is a lot of theory, but it is very logical, and there is a potential of this being asked in exam. There is a comparison between the traditional sources, traditional EOQ approach, and the GST system. You can quickly pause and take a look, but essentially the difference is optimize inventory levels versus eliminating inventory altogether. That is a key difference. You can take a quick look, you can pause the screen and read. The key learning point summary, again you can pause. I am zooming out so that you can pause, you can take a screenshot, and you can quickly read. Okay, now going to the next chapter of account receivables and payables. But before we move to the next chapter, let us take a break for 5 minutes. And exactly in 5 minutes, the timer will show 10 minutes, but we'll take a break of only 5 minutes. Exactly in 5 minutes, we'll come back and resume chapter number 9. Hello everyone, welcome back. Let us quickly get started with chapter 9, which is accounts receivable and payable. The previous chapter we saw the inventory control management system. This chapter is about how to optimize and manage effectively, I would say, the accounts receivable and payable. Now just logically think what will be the balancing act for receivables. See, lower receivable means lower credit policy that you'll offer to the customers. If you offer lower credit to the customers, then there's a potential that your customers shift to your competitors. So your profitability will take a hit. But with lower credit sales policy, you will be able to minimize the risk of bad debt. You'll be able to minimize the funds that will be blocked in receivables. But with higher funds blocked in receivables, while your sales can increase, there is a higher risk of bad debt, and hence there is going to be a profitability versus liquidity focus. Your optimal policy is where you maximize the net benefit, which is additional profit less additional cost of credit. Okay, so how do you decide the right credit policy framework? How much to give, how much credit to give to the customer? Number one, you assess the credit worthiness of the customers through bank references, through trade references, through credit scoring, internal records, so on and so forth. Setting a credit limit, maximum amount of credit, and then if the customer breaches that maximum amount of credit, you do not supply to them until they have paid off the amount from the previous orders. Invoicing and debt collection, you invoice promptly as soon as the customer receives the because the credit period starts as soon as the customer receives the invoice, and then you really monitor the debt collection. On day one, you send a reminder, then phone call, then email, and then finally you might want to appoint at some point, you might want to appoint a collection agency. If it still does not work, at some point you might want to initiate a legal action. Lastly, monitoring performances, aged debtor analysis, which is a primary tool for monitoring. It breaks down debts by how long they have been outstanding, which is option with 0 to 30 days, 31st to 60, 91, 61 to 90, which is concerning, a 90 plus, which is very, very high risk. So you should also look at credit management ratios, which is collection period, which we've discussed in the previous chapter, receivables turnover as well as bad debt ratio. These two are new. Okay. Ratios, however, remember, these are indicators, not targets. But basis all of these four, you'll be able to decide how much of credit to be able to give to your customers. This is effectively the credit assessment framework. So financing cost of receivables, what is the cost of financing the receivables? The average trade receivables, the amount that is blocked in the average trade receivables into your cost of credit, which is your annual interest rate. That is the cost of financing the receivables. Let's say annual credit sales is this, your receivables is this. So this receivables into 11%, not 24 million into 11%, but 4.8 million into 11% will be your financing cost. Okay. Now let's say you might want to think, okay, should I give a discount to my customer if they were willing to pay me earlier? How do you decide how much of a discount to give versus not to give? You will say, okay, I will give a discount, and if that discount the loss of the discount is lesser than the gain on the interest savings, then I will give the discount. But if my loss on the discount, the amount that I will get lesser, is higher than the cost of financing, then I might as well tell, okay, you pay at the right time, I don't want to give you any discount. So what is your effective annual cost? Your effective annual cost, remember, if you give a discount of 2%, it is not a 2% discount on 100, it is effectively a 2% discount on a payment that you receive of 98, because you'll not receive 100 now, you'll receive 98. So it is 1 plus 2%, which is 2 divided by 100 minus 2, so 1 plus 1 plus 2 by 98 raised to n. N is what? N is the number of periods, which is n being 365 divided by reduction in the collection period. It is the number of times effectively. Okay. And then if your effective annual cost is lesser than your overdraft rate, then you offer the discount. But if your effective annual cost is higher, if you are having a higher cost than you would have paid the interest, might as well pay the lower interest and do not offer the discount. Just quickly an example, Zenith Co allows 60 days to pay, considering a 2.5% discount for payment within 15 days. Okay, so if you pay within 15 days, what is the amount, what is the number of days that you save? Receive payment early is 45 days. So your N is how many How many cycles do you save? You end up saving 8.111 cycles, which is 365 divided by 45. So your reduction is in 8 point n being 8.111. So effective cost is how much? Effective cost is 1 plus, what is the discount? 2.5. 100 divided by 2.5, 100 minus 2.5 is 97.5 raised to 8.111. This number comes to 22.84%, but your overdraft cost was 15%, and hence given this effective annual cost of offering a discount is higher than your discount rate, you will end up not offering. You will say 15% is cheaper, it's cheaper to use the overdraft, so why should I take this up? There are also partial options where you say I will offer 1.5% discount for 15-day payment, where only 35% people take this up. So you will then calculate the cost. Only for the 35% people. For the 35% people, you will say my total receivables will be 35% will pay me in 15 days, the remaining will pay me in 73 days, and hence my total receivables will be a combination of the 15-day payments and the 73-day payments. Now you would have financed it. Cost of financing would be this. What is the discount that you are offering? Discount that you are offering is total receivables of 10.5 million, which is, remember, it is 35%. So 10.5 million into 1.5% that you will save, or rather you will have to bear the cost of discount. So your cost will be 157,000. So your total cost now is 547,000. Earlier your total cost was 540,000, which means you have an increase. If you have an increase in cost, you will say I don't want to give any discount because of the discount I'm increasing the cost. Much rather I should have gone for the current financing, which is where I have 6 million receivables. On 6 million I will have to end up paying, and I will have to end up paying 9%. Okay, I'll have to end up paying 9% for the full year. Okay, very clear. You can see how we found the 35% and 65%. I hope that is clear. 35% of the sales, effectively the 30 million sales, and 65% of the 30 million sales. So effectively what happened is from 6 million your sales reduced to 4.3 million, but despite the reduce in your receivables, from 6 million to 4.3, your cost actually increased to 547,000 from 540,000, which means do not introduce. Okay, there's another practice question. You can pause and you can take a look, same as the previous one. A lot of companies, what they do is they go for factoring. What is a factoring? Factoring means there are agencies which give you a service where they say we will take over your receivables, we will give you an administrative service. You do not have to keep the headache of keep calling your customers, etc. We'll do it for you. We will collect it from you, and what we'll do is we'll give you advance money right now itself. Even if the customer is going to give you after 73 days, take the money from us today itself, and what you can do is the customer can give you the money after 73 days. We'll take the money from the customers, you take the money, and what they will do, they'll keep a cut. Let's say if the customer is going to give 100, they will say what we'll do is we'll give you 98 today, and 2% will be our charge for the administrative fee, interest fee, whatever, everything combined. There are two types of factoring. One is with recourse, one is without recourse. Without recourse means even if there's a bad debt, even if the customer defaults, the factoring company will bear the loss. The actual company who's made the sale will not bear the loss. But with recourse means, there's a recourse with the factoring company. If the customer defaults, then it will come back to the company that has made the sale, and it will say please give me the money back because your customer has defaulted. So 3 core services that a factoring gives you: sales administration, credit insurance, and advanced financing, typically 80% immediately. With recourse means the client retains the bad debt risk, which is lower cost factoring, and without recourse means the factor bears the bad debt risk, which is generally higher cost. The advantages and disadvantages, you can pause and take a quick look. Okay, so there's a example of factoring evaluation. Total sales is 20 million, 4 million receivables, 10%. Rate of overdraft, interest on overdraft is 10%. Factor says he will charge 2% of sales, but he's guaranteeing payments after 50 days. Admin savings will be 120k. Okay, so what is your current expenses on financing? Current expenses is 4 million. Why 4 million, not 20 million? Because your receivables are only 4 million throughout the year, so you'll spend 10% on those 4 million, which is 400,000. Okay, with factor, what happens? What is your total cost with factor? New receivables will be, instead of 73 days, now you'll have to block your money only for 50 days. So our receivables reduce from 4 million to 7 million. What is the cost of financing? 2.7 million, 273,000. Again 10%, same logic. But what also happens here is there is an admin saving of 120k, which is why you will reduce it because there is a saving. But at the same time, there is a factor fee, which is flat fee on the entire sales. So you'll have to add an expense of 400,000. Honestly, not logical. Before even seeing the answer, I can tell you factor fee itself is equal to the financing cost. If anything, there is a higher element of financing cost, less net benefit. So your net cost for factoring is higher than your previous cost, which means you should reject the factoring option. You should not go for it. The next example is also quite similar. You can pause, although over here also they are ending up rejecting. So in exam, you need to just evaluate whether it makes sense to go for factoring or you should continue the existing model. Just like we did that for discount, should you offer discount versus continue without offering discount, you need to do the same, go ahead with the same logic. Okay. Next is invoice discounting. Invoice discounting effectively is similar to factoring and yet different. In case of factoring, you go to the factor, you give all the names of the customers, they will coordinate with the customer. In case of invoice discounting, you retain all the admin processes, you have to reach out to the customers, etc. But the bank, it is almost like a negotiable instrument with the bank. You tell the bank, I have XYZ number of sales invoices yet to receive the payments, please give me an advance against these invoices. As soon as I receive these invoices, I will give the amount to you. So the key feature is it is confidential. The customers are unaware. The customers are unaware that you have done this discounting. In case of factoring, the customers become aware. There are selective invoices only and the company retains control. It is finance only, no admin and insurance. Like I told you, the company retains the benefit of, or rather not the benefit, I would say the burden of admin and insurance, typically 80% advance though that you will get, and lower cost than factoring. Why? Because there is no insurance and there is no admin work. Is suitable for financially strong firms with good internal control systems, good internal control, so that they can directly manage the data themselves, the folks to whom they have sold a credit. The difference between invoice discounting and factoring: credit control, company retains over here. The factor will assume the credit control. He will call the debtors and collect the money from them. Customer awareness: in case of invoice discounting, it is confidential. In case of factoring, it is disclosed, as we discussed. For financing, there is finance. For invoice discounting, it is finance only, but for factoring, it is in finance plus admin plus insurance. Finally, the cost over here is lower. Cost over here is excuse me, over here is higher. This is important. This is an important point from a section A perspective. Now again, a very similar type of question. The only difference is the service fee over here is lower. You do the cost comparison and you will say, yes, am I actually saving money? The answer is what? So in case of, what do you have to calculate actually? So Cascade Co 450k invoices, 30-day terms, discounter advances, this plus. So what is the total cost? Total cost is what you are expected to calculate. Calculate total cost. Total cost is what? The cost of advance, and after 30 days when the customers pay, then there's an interest, there's a service fee. So what is the balance? So what is the amount that you will receive from the factor at that point in time? That factor minus your, what is the total amount that you should have received? So 450k you should have received, less 443k you've actually received from your I would say whosoever has done the discounting, and hence 6,549 is what your cost has been, which is 1.46%, which is 1.46%. Okay. So effectively, if they give you an advance of 80%, they will charge an interest on that advance of 10%, plus they will charge a service fee on the entire amount. See, remember, they will charge interest only on the amount of advance, but they will charge service fee on the entire amount of sales. Okay. So you need to calculate the total cost. Next two also you can take a quick look, very similar to the factoring question. Okay. For account payable management, absolutely reverse as what we discussed in receivables, but the concept being the same. You still have to balance profitability and liquidity. What is profitability? Profitability over here would be, or let's say liquidity over here would be to have higher payable terms. If you have higher payment terms, then what happens? You can keep higher liquidity with you. You can enjoy free financing, right? You can enjoy free financing, but then what happens at the same time is you end up damaging the relationship. So you have to end up managing the two. You have to trade. Instead of profitability over here, there's a trade-off between liquidity and relationship. Okay. There's a risk of stretching payables because you will lose the goodwill of suppliers, you lose their trust, you will lose any discounts which of early payment, and finally future price increases will be done by the suppliers to compensate for the slow payments. You might think that you are getting free credit, but in effect the suppliers in some shape or form are ending up charging you. Okay, so what is the annual benefit formula? The same formula as receivables, which is 1 plus discount divided by 100% minus discount rate, whole raised to n minus 1. This represents the cost, however, of not taking the discount. In case of receivables, you are giving the discount. Over here you are going to get the discount, and hence if the annual benefit of getting the discount, is higher than your overdraft rate, then what you do is you will take the discount. You will end up taking the discount. Okay, if your actual benefit from discount is higher than your overdraft rate, you take the discount. Otherwise, if your overdraft rate is higher, annual benefit is lower, you might as well stretch the payables for more period, so that you are saving interest on the overdraft in effect. There's an example, 12K invoice. The terms are 315 net 45. What does 315 net 45 mean? It means that while you have to pay in 45 days, if you pay in 45 days, you get 0% discount. If you pay in 15 days, you get 3% discount. So, excuse me. So, effectively, you will have to end up saving, you will be saving 30, or the supplier will be saving 30 days, you will be paying 30 days in advance. If you pay 30 days in advance, you get 3% benefit. So, days saved 30, and we've calculated 365 divided by 30, which is 12.167. Annual benefit is 44.89%, which is greater than your overdraft. So annual benefit will be much higher, and hence you should end up taking the discount. This is absolutely opposite receivables. Why? Because over here you are saving overdraft. This is the cost of not taking the discount. Effectively, think of it this way: if you make the payment late, then you don't have to borrow money from overdraft to that extent. Okay, so this is how you should take the logic. This topic, next one, is a theory topic, which is foreign accounts receivable and payable. Foreign accounts receivable, what is the key difference? See, in case of exports, imports, the customers are sitting abroad. If the customers are sitting abroad, there is a higher risk of them not making the payment. So what is the risk? Export credit risk, customer insolvency, different legal systems. How do you file a battle? Because they are sitting in a different country. Banking systems could be different. There could be restrictions of currency transfer. And finally, what if there is a political risk? Biggest example, of course, is what is going on right now in terms of the war between Middle East and the West. There are a lot of management techniques to how you manage this export credit risk, which is, example is letter of credit, bills of exchange, export credit insurance, bank guarantee, payment in advance, and so on and so forth. You can take a look, you can take a read. Foreign exchange transaction risk, we've already discussed. There's a concept of forfeiting. This is not forfeiting, this is forfeiting. What is forfeiting? Without recourse purchase of foreign receivables by forfeiter. Okay, this means it's quite similar to factoring, except that this is without recourse. The forfeiter bears all the risk, medium term, but this requires debt instruments. You should have a bill of exchange. There should be a discount basis, and eventually often requires a bank guarantee. But the benefit is this is completely transferring your risk. You get the cash immediately. There is no recourse. But then the problem is this requires bank guarantee, and this involves a high cost. How do you take the forfeiting decision? Very similar to the decision that you used to take for factoring, which is your forfeiting cost will be 20,000, but there will be a cash flow benefit to the extent of 90 days. You will be saving the interest, which is 11,000. So your net cost will be 8,186 for forfeiting. That is your next cost. Decision factor, you will favor forfeiting if there is a high credit risk or political instability or FX volatility, but you will favor rejecting because you know your customer will end up paying you. There is a low FX volatility. And hence, if your probability of default, if the probability of your bad debt into the amount of loss into probability, so basically expected loss, if it is higher than 8164, your forfeit is rational. You need to mention all of this in the examination. Only calculation will not help. Okay. Finally, working capital cycle integration, which we've already discussed in the first chapter. Cash operating cycle. What is the objective? Minimize the operating cycle. So what are the strategies? For inventory, you go for GIT. For receivables, you go for a tighter control, or you can also end up giving them some discounts. You can at the same time extend payables without damaging the relationships. There are two policy approaches. There is an aggressive policy, which is you keep lower operating cycle. Conservative policy, you keep a higher operating cycle, where you are generous to your customers, you keep high inventory, you pay to your suppliers early. Your optimal balance depends on industry, your financial strength, your efficiency, your growth stage, your risk tolerance, and your competition. A lot of these factors. Okay, I will again show you this. You can please pause the screen, take a screenshot, take a look at the common mistakes that one might make from this chapter, all the essential concepts, the checklist for calculation, and of course all the formulae from this chapter. I will give you another break of 5 quick minutes before we move to the last chapter of working capital management. Okay, in the meantime, maybe you can take a screenshot of these and you can take a you can read until we come back. Hello everyone, welcome back to this last chapter of working capital management, which talks about cash and funding strategies. So first of all, why do you hold cash? That is the question. I think three motivations to hold cash. Um, Number one is transaction. If you have to incur a transaction, you need cash. If you want to make investments, you need cash. And finally, as a precaution, uh, just like as an individual also, if you think, right, there are three motivations to hold cash exactly. If you want to make expenses, which is transactions. If you want, you might want to hold funds for a contingency, which is precautionary motive. And finally, to make expenses on a day-to-day basis. Of course, for a business, day-to-day expenses will be payroll, suppliers, and utilities. Over here also, cash management means balancing between liquidity and profitability, correct? Something that we've been discussing since the first chapter of working capital management. What are the consequences of having insufficient cash? Of course, then if you don't have cash, you will not be able to make payments to your laborers. There will be disputes with the laborers. There will be legal proceedings. You might go insolvent, damaged credit rating, and loss of supplier relationships because if you are not able to pay them in time. Cash budgets and cash flow forecasts, estimate of receivables and payables under existing conditions, which is cash forecast, basis the existing demand, basis how much you expect to purchase, etc. What is the amount of cash that you expect to have in your hand by the end of a particular period. What is the cash budget, which is how much amount you wanted to have, what was your target after the corrective actions, which is your cash budget. And key difference essentially is forecast means what is expected, budget means what management commits to achieving. The uses of cash budgets: assess and integrate operating budgets. What are operating budgets? Different departments have their own budget, sales, purchase, so on and so forth. You will integrate all of these, and then finally you reach at a cash position. You plan for cash shortages and surpluses. If there is a surplus, you decide where to invest. If there's going to be a shortage, you decide where to have money from, which source. And finally, you compare with the actual spending to monitor the performance and take a corrective action. There are three ways to forecast. One way is a classical receipts minus payments method. You forecast your receipts. Receipts could be cash sales and credit collections, and then payments could be materials, labor, asset purchases, and overheads. So total payments, receipts minus payments means net cash flow. Add the opening balance, you will reach to the closing balance. Key considerations: cash timing differs from accounting recognition, and hence you might want to go with the receipt payment approach. Exclude all the non-cash items like depreciation, of course. Include capital transactions which are cash in nature, even if they do not affect the P&L. And finally, credit periods affect the timing. You will have the impact of credit sales or purchases only at the time of the actual receipt or payment, right? Now, talking about the cash budget. Cash budget essentially illustration. As you can look at the detailed illustration, but I will just give you the key points. Let's say 90,000 Feb sales, 40% cash. Okay, so 9 fours are 36,000. 36,000 in February will be cash sales. Okay, and credit sales, 60% of the credit sales. So the remaining 54,000 will be collected in March. Okay, opening receivables were 45,000, so opening collections will be 45,000. Material purchases will be 50% of next month's sales. Sales of February is 90,000, so 50% of the next month's sales you will be purchasing in the previous month. So 90,000 into 50% will be 45,000, but 45,000 you will pay 1 month in arrears. So essentially 45,000 you would have purchased in January, but you will pay in February 45,000. Okay, opening payables however 22,000. Okay, wages 15k a month, you will pay every month 15k, and overheads 8k a month, you will pay 8,000 every month. Opening cash was 12,000. Closing balance of Jan becomes opening balance of Feb, and so on and so forth. Okay, so this is how you will evaluate. Method 2, statement of financial position forecast, predicts the future balance sheet, predicts your future balance sheet, and derives the cash as a balancing figure. So what is the balance sheet approach? You will say you will forecast what your assets and liabilities will be at the end of this period, and hence the difference should be the cash, that is the total cash that is needed. As you can see in this example, you forecasted the net current assets, or rather the non-current assets. You've forecasted the retained earnings, the total equity and liabilities, hence all the assets excluding the cash you forecasted, right? So this is the total assets. You forecasted the total assets excluding cash. Okay, so forecasted the total assets excluding cash. Now you have to decide. What is the cash required, and hence what is the cash flow increase. Increase as in you had 15k of cash. But you ended up needing 60k, which means you need an extra of you will have a cash flow increase of 45,000. You can take a look that inventory has increased by 10% this year. Receivables have increased by 15% this year. Okay, last year you had 240k, but this year now you have 240k plus inventory over here, less 80.5k of receivables. Okay, so this is how you will end up taking the balance sheet approach. Remember, the year for which you are taking this approach has to be a forecast. What are the forecasters of assets as well as liabilities? What do you forecast? Assets, liabilities, and then you take a difference. You find out what is the cash required minus what is the cash that you had, and hence what will be the cash flow increase during the year. Method 3 is the working capital ratios approach, where you are given the number of days. You take the number of days essentially to find out. So this is more like the cash flow statement approach. In the cash flow statement, you have an operating cash flow where what do? You start with the operating profit, you add back all the non-cash expenses, and then what you do is you add all the financing that you have raised, you add all the funds from all the let's say all the assets that you have sold during the year, and then you subtract all the interest payments that you've made, you subtract all the loss of the assets, you subtract all the assets that you have purchased, right? That you have purchased, the amount that you have spent to purchase any assets, any redemption of long-term funds, any equity that you've paid back, tax that you pay, dividend that you pay, and finally what is the increase in working capital. So this effectively is nothing but your cash flow statement in a way. This is nothing but a cash flow statement in a way. Okay, and you can take a look. I am not solving this in the interest of time, but this is solved using the working capital ratios method, which essentially is nothing but you start with the operating profit, add back all the non-cash expenses, then you get the total cash generated from operations, all the investing and financing activities, all the amounts incurred in investing, which is buying new assets, all the amounts received from investing activities, as in all the redemptions, all the sale of assets, all the financing activities, all the redemptions you would have made, which is cash would have gone out if you redeem your debentures, etc. But if you issue new debentures, issue new equity, etc., cash would have come in. Finally, you also pay tax, you pay dividend, you pay interest, all of that is going to be reduced. Okay, so what is centralized treasury management? I think we've discussed this in one of the other chapters, but if there is a dedicated treasury department, instead of, so if there's a holding company and there are 15 subsidiaries, if there is just one treasury department which manages cash, which invests cash, which borrows cash, if there's just one team that deals with the cash at one place, which if there is cash needed, it will borrow cash. If they had extra surplus cash, they will invest cash. There's one option that every subsidiary or every country has its own, every subsidiary in a country has its own treasury department, or the holding company has a centralized treasury department on behalf of all the subsidiaries. If the benefit of the centralized department is it pools the cash, it will be able to net all the, one subsidiary owes money, another subsidiary has to receive the money, it will net all the requirement. There will be economies of the scale, which is you will manage banking relationships from one end. If you borrow only from one source, you will have a lower borrowing source, you will have an improved control, reduce idle balances. If 5 subsidiaries have idle balances, they can send it to the holding company, and then if another subsidiary needs, the holding company can use the same idle balance to go get over their expertise. You can have expertise teams, and finally you can have access to wholesale money markets. But the disadvantage is the autonomy of those subsidiaries will be lost. There will be challenges in communication, single point failure. If one team underperforms, then there is going to be a big problem. Currency management complexity, your subsidiaries might be located in different countries, and finally initial setup cost. Exam relevance, this is an important topic. Centralized treasury management is testable in discussion questions, and remember, there is a difference between state and discuss or describe. whenever there is a word called discuss or describe, then you have to elaborate the answer, not just state the points. You have to explain. For example, don't just explain, don't just write reduced idle balances, explain the entire logic to it. Okay. There are cash management models, just like there was EOQ for inventory. What is the right amount of cash? Because having higher cash means there's an opportunity cost of investment, or let's say if you have borrowed funds, then there's a cost of funding. But then at the same time, having lower cost, having lower amount of cash means there will be a higher transaction cost. So the same logic, except CO over here will be transaction cost, and CH over here will be holding cost of funds, okay, which is nothing but the interest rates. And finally D over there was demand for inventory. Here there is an annual cash demand. So the formula is the same, the logic is absolutely the same. Over there it was ordering cost equal to holding cost, over here it is transaction cost is equal to the holding cost. The formula is absolutely the same as EOQ what we had discussed. Next is the Miller-Orr model, which is it incorporates the uncertainty through upper and lower control limits with the return point Z. It basically says there are 3 points. There is an H point, high amount of cash. There is a Z point, which is the return point, and there is a low amount of cash. So the difference between H and Z is effectively S. This is called as the spread. Which is S. And then the difference between Z and S is nothing but S divided by 3, 1/3 of the spread. What happens between H and L? Cash operates freely. And then if the cash is between H to Z, what do? You transfer the excess amount to investments. If the cash is between Z and L, then you redeem some of the investments, to return to the level of Z. What is the formula? The formula is, what is the formula of S? S is what? S is the spread. S is equal to the spread. So S is 3 into the transaction cost into the variance. Remember, variance, if variance is not given in the question, if standard deviation is given, then variance is standard deviation square. Variance as well as interest rate need to be given in daily terms. So the daily variance and divided by 4 into the interest rate has to be the daily interest rate. The whole has to be cube rooted, and then finally you will have to multiply it by 3. This is the spread. What is the return point? Return point is, which is Z. Z is nothing but L plus S divided by 3. So the difference between Z and L is S divided by 3. Okay, but the H is nothing but Z, or I would say L plus S. This is H to L is S. So effectively, if this is S divided by 3, then this is S divided by 3 into 2. So 1/3 of the spread is between Z and L, and 2/3 of the spread is between H and Z. Okay. So upper limit H is L plus S. Critical note, as we discussed, variance and interest rate must be in daily terms. If given in standard deviation, square it to obtain the variance. So let us look at an example. Minimum cash would be 25K. Minimum cash is what? L is what? Minimum cash. H is the maximum cash that you would want to hold. What is the transaction cost? They've given it at 60. Okay, the daily variance is given at 16 million. Daily interest rate is given. What is the formula? 3 into bracket 3 into transaction cost was 60 into what was the daily variance? 16 million divided by 4 into what is the interest rate? 0.025%. The whole cube root of the whole thing, and then finally multiplied by 3. That over here is given as 42,683. Okay, so this is what? This is your spread. Now L plus S comes to H. So higher limit is 25,000, which is L, plus S gives you higher limit. Return point was L plus S by 3. What is S? S is 42,683. Spread divided by 3 will give you your lower point. What does this mean? It means that if the cash is between 39 to 67,000, then you invest, and if the cash is between 25 to 39,000, then you redeem. Okay, so you transfer 28,455 to investments as soon as the cash is between H to Z, and then at 25,000. At 25,000, when the cash is at L, you liquidate 14,228 from your investments. So this could be tested in the examination. Remember the formula, remember the logic, which is at the moment the cash is at H, you will invest the difference. You will not invest the entire thing, you will just invest the difference between H to Z. And as soon as the cash is at L, you will redeem how much? Z minus L, which is nothing but S by 3. Okay. Short-term investment and borrowing, as you will also see in the chapter of all of this is also covered in chapter 12. Chapter 12 is sources of finance. There are short-term sources, there are long-term sources. Short-term sources of finance are bank overdraft, there will be treasury bills, there will be certificate of deposits, there will be gilt, so on and so forth. Not GYLT, GILT basically. So there will be a number of these short-term sources of finance. Remember, it is important that short-term sources of finance are financing the short-term investments, and long-term sources of finance finance the long-term investments. If short-term sources of finance are financing the longer-term investments, then it's a problem, and vice versa is also a problem. So short-term cash investments have to balance three objectives: liquidity, safety, and profitability. So what are the decision-making factors? The rates are expected to fall. Invest long-term at fixed rate. You lock the fixed rate. If the rates are going to fall, you lock the higher rate. If the rates are expected to rise, then you invest in the short term at variable rates, such that as soon as the rates go up, then you invest at a fixed rate. Till then you invest it at a variable rate. Okay. Known timing, then you match the maturity to your cash needs. But if you have an uncertain timings, then you choose your instruments with secondary markets. With secondary markets, as in which can be easily sold or bought. Which means if you've invested, right? If you've invested but you don't know when you need the money, you will go with secondary market investments, such that as soon as you need the money, you can liquidate by selling into the market. Common short-term investment instruments: bank deposits, treasury bills, certificate of deposits, commercial papers, money market funds, and gilts. I'm not reading through all of these. These are already covered in the chapter of sources of finance. There's a lot of theory, but you can quickly take a look. It is very, very simple and understandable. You can probably pause the screen right now. I can zoom in it for you all. You can pause the screen right now and you can take a quick look at all of these. Okay. Now, short-term borrowing, you can go for bank overdrafts. You can go for bank loans. What were these? These were all money market. These were money market investment instruments if you have to invest. But what if you have to borrow? If you have to borrow, then you will go for bank loans or bank overdraft. Remember, that was for investment. This is for borrowing. Okay. Both of these have certain advantages. There are other sources also, which are bills of exchange, debt factoring we already discussed, and trade credit, which is nothing but payables. Bill of exchange will come into account for mainly the export sales. Overdraft versus loan, they need a financing 1 month, 2nd month, 3rd month, 4th month, and 5th month, and 6th month. Okay. So the average overdraft requirement is 30,833 for 6 months. So 8% for 6 months. The cost will be 1,233. If you end up taking a loan at 7% of 50,000, if you take a fixed amount of loan, there's two options. You go for overdraft. Overdraft will have a higher interest rate, but then you pay only for the amount that you have used. Loan will be a fixed amount and a fixed interest rate, and hence this interest at loan is higher, which means you go for overdraft. You end up saving some amount despite a higher rate of interest, because of the flexibility of paying of interest only on the actual usage of funds. Loan repayment calculation, annual payment will be loan amount divided by the annuity factor. Some of you might be wondering how are EMIs calculated, equated monthly installments. There's a month, just like there's an annuity factor, there'll be some factor there. Total loan amount divided by the factor over there will give you the annual payment. Okay, you can take a look at this example. Finally, what are the strategies for funding working capital? There will be a permanent working capital, there will be a fluctuating current asset. So what happens when there is permanent working capital? At least that amount of current assets will be maintained, which is the minimum inventory level, the base level of receivables, the buffer cash balance, and the minimum raw materials, which is permanent in the sense that they are continuously maintained, even though the specific items change constantly. Okay, who are the customers will change, what is the inventory will change, but the value will remain the same. Fluctuating current assets means depending on the market, if your demand in a certain month is higher, if you know there is going to be a season, if you know a cycle is going to be there, if you have gotten a one-off order, then in all of these situations, your temporarily current assets might rise. You have fluctuating current asset which is higher, let's say additional inventory in month of December for Christmas sales, but 200k will be permanent year round. You will have at least 200k worth of inventory and receivables. Costs and risks, the same point that I was mentioning earlier, short term for short term, long term for long term. Short term finance will be a lower cost, which is typically only 2 to 5% over the base rate, but long term finance will have higher cost because it compensates the lender for a longer exposure. Longer exposure means longer risk. Okay, so what will a lot of CFOs do? A lot of CFOs, what they will do is they will go ahead and take a risk. What is the risk that they will take? They will say, I will take a short term finance and I will finance my long term assets. Why? They will say short term finance is cheaper, so I will take that risk. Okay, this is what people end up doing. So there are three funding strategies from a cash perspective. One is you match the asset and liability duration, which is non-current assets, you go for long-term finance. Permanent current assets, you go for long-term finance. But for fluctuating current assets, you go for a short-term finance. What is the logic? Because assets and liabilities match together, reducing the refinancing risk while minimizing the excess long-term debt. What are the characteristics? Moderate risk and cost, which is logical alignment. Okay, now let's say you match. Okay, how do you match? You will say 500k non-current assets, I will take long-term finance. Permanent current assets, I will take a long-term finance. Fluctuating, I will take a short-term finance. So non-current assets, I will go for equity. Over here 200k I will go for debt, and 100k I might go for equity. So your total cost is going to be 100k, 12.5% weighted, and your current ratio is nothing but 300 by 100. What is 300? Total current assets, which is 200 plus 100, and your total current liabilities is nothing but the short-term debt of 100k. So 3:1. This is one approach, which is the ideal approach, where you would want to ideally match the assets and the liabilities, but the duration of assets and liabilities. But an aggressive approach will say, I will maximize the short-term finance. Why? As I told you, people will say because short-term finance is cheaper, I will take a short-term finance to minimize the cost, and I will fund most of these current assets, including the permanent portion, with short-term finance to maximize the profitability, accepting higher refinancing risk. Okay, and here they have solved it. They say now what happens is the total cost is much lower, you are saving 5k, but then your current ratio goes for a toss. It has effectively come down from 3 to 1.5, and a conservative approach is exactly different. They will say, I don't need any short-term finance, I will take only and only long-term finance, or I will take only very less short-term finance. I will predominantly use the longer term finance. I'll use all permanent plus a portion of fluctuating also using longer term finance, because I want to prioritize my financial stability. Okay, your costs will be higher, but your current ratio has jumped up to 6:1. Your cost will be 2.5k more than matching. This is a summary of the strategy comparison between aggressive, matching, and conservative. What are the factors that influence the strategy choice, whether you should go for the moderate strategy or aggressive or conservative? Of course, first of all, what is management's risk attitude? What is the industry that the company is playing in? What is the size of the company? What is the variability of the working capital? Their previous experience, and finally, cost of capital differential, the credit availability and the credit rating. The difference will be only if there is a short-term and long-term difference, then only one might be incentivized to go for an aggressive policy. Otherwise, if the difference is anyway same, it doesn't matter. If there is a small spread, you will ideally be less incented to go for aggressive, might as well take longer-term loans, right? If your previous experience, there have been liquidity crises, you will be focused on conservative. If you will say, no, I've never faced these crises historically, I will always go for an aggressive approach. Of course, industry categories, also industry characteristics matter. For seasonal businesses, matching matters, volatile, conservative matters, and stable cash flows, aggressive is helpful. Strong credit rating, I anyways have more financing options, then I can be a bit more aggressive. Weak credit rating, I anyways have lower options, so I have to be conservative. Lastly, investment policy versus financing policy. Working capital investment policy looks at how much to invest in current assets, comparing one company with another. Conservative investment policy, we've been discussing throughout last 4 chapters, which is you keep higher inventory, you keep higher receivables, you keep paying your payables fast, okay, generous credit terms, but your large cash balances. Aggressive investment policy will be GIT inventory, strict credit control, and minimal cash. But working capital financing policy, remember, investment and financing are 2 separate decisions. How to finance working capital is different. Aggressive means you will finance the working capital with a high portion of short-term finance. Conservative means you will have a high portion of long-term finance, and moderate means matching the duration of assets and liabilities. Do not confuse the two to a question of financing policy. This is financing policy. will not give marks for discussing the liquidity and profitability trade-off. Liquidity and profitability trade-off will come only if you are investing. This is where liquidity and profitability trade-off comes. Questions on investment policy will require the discussion of working capital levels, not funding sources. So do not make this mistake which people generally make. I will again go to the end of this chapter. These are a few exam tips. You can take a screenshot. Please feel free to read these, and there are some of these common errors which people generally end up making. Please try to pause, take a quick look, and try not to repeat the same mistakes in exams. There are summary of key formulas as well. Again, very important to revise the formulae at least a couple of hours before the exam so that you do not make a mistake. Okay, so that's it for today, and that's it for the purpose of the revision for this cycle. We've managed to revise the entire investment appraisal, we've managed to revise the entire working capital management, and we've managed to revise the foreign exchange risk management. Of course, would like to revise much more, but due to the paucity of time, and wishing you all the very best for the examinations. I truly hope you pass with flying colors, and if this video has been even remotely helpful, please do mention that in the comments. Do not forget to share the video with all of your friends, not just who are appearing in March 26, but all those who are even planning to appear in the June 26 exams or onwards. And has been a pleasure to be able to teach you. Having said that, all the very best again. Hope you clear with flying colors. Do not forget to subscribe to this channel. Do share with all the ACCA students, whether current students or those who are planning to appear in financial management exams in the quarters to come. All the very best. See you. Thank you so much. Bye-bye.